What is dollar cost averaging? Is dollar cost averaging a savvy way to invest or silly gimmick that can lower your returns? And how much is your house worth as a rental property? We'll answer these questions and more on this, the 71st episode of the DoughRoller podcast.
Welcome to the DoughRoller podcast, where the best thing money can buy is financial freedom. We help you make more, spend less, and invest the rest. And now your host, Rob Berger.
Whether you're just starting out, buried under a mountain of debt, or well on your way to financial freedom, this is the podcast to help you take your finances to the next level. Hey everybody, this podcast is sponsored by Betterment, the most preferred automated investing service. Betterment has cutting-edge technology to optimize returns, minimize taxes, and save you time and money. Join over 34,000 customers who have already streamlined their portfolio management at betterment.com/roller. That's betterment.com/ROLLER. Okay, so today we are going to be answering a question I received from a listener named Pam about dollar cost averaging, a term you may have heard of. It's a term that gets written a lot about in finance sites and blogs and books, and so we're going to cover that topic today: what it is, what it's not. Is it a good thing, a bad thing? Should you use it? Should you avoid it? Do you care? Should any of us care? That's the topic of today. Before we get to that, though, a quick money tip of the day. And it is a tool, a free online tool called Rentometer. Perhaps you've heard of it. It's one that I use every now and again. The idea, it's kind of like, I think of it kind of like a Zillow, although Zillow's kind of moved into this market. I think of Zillow as a site where you can go to look at home values. For buying and selling, not for renting, although they do list rentals as well. But the idea of Rentometer is you can plug in any address and get an idea of what that property should rent for. And it not unlike the value of homes for sale, they use comparables. And so you can put your own home in, or if you're renting, are you overpaying? Or if you're a landlord, what should you charge? Again, I don't think Rentometer, it's not gospel. It's just a data point. And I know I put our address in for our home, and it gave us the sort of the median rent in our area based on size of property. But then it also shows you, and this is what I find particularly interesting, homes in our neighborhood that are either for rent now or have been rented, and the information has been provided to Rentometer, so you can see what other homes in your neighborhood are renting for. And this is something not for the immediate future, but my wife and I have often thought that when we get to a point where maybe we want to downsize or move, whatever, we might consider renting our home rather than selling it. And we're not to that decision yet. But I kind of keep an eye on rental values in our neighborhood. And anyway, rentometer.com, that's the tool of the day. Check it out if you're interested. Again, it can help you figure out what your property might rent for, or if you're in the market to rent a home, townhome, whatever, or if you are in a rental and you want to know if you're overpaying, it might give you some sense of what's out there, what a fair rent would be. So that's rentometer.com. Okay. On to the main topic of the day, dollar cost averaging. This question comes from a listener named Pam. She writes in and says, I enjoy listening to and learning from your podcasts and thought you might be able to give me some advice about how to reallocate a large 401k balance. My husband's company recently moved his 401k plan over to Fidelity from another plan. They moved all of his money into a default fund, which is the Fidelity Freedom Fund for his retirement age. We would really like to move all of the money into other funds in the plan that have better expense ratios and performance, but are not sure how to proceed. Should we move the money to the new funds all at once or move smaller amounts over a period of time? Any advice you can provide would be greatly appreciated. Now, the situation that Pam outlines is actually somewhat unique as it relates to dollar cost averaging, and I'll explain why in a minute. The situation she presents is not the normal one. When folks email me about this, and I've received over since blogging, on personal finance and investing since 2007, I don't even know the number of emails that I've received on this very question. Should I invest a lump sum right now, or should I spread it out over a period of time? Her question, though, is unique, and I'll explain why in a minute. But just to focus on her question, and so we're all on the same page, the Fidelity Freedom Fund is sort of like a target date retirement fund that I've talked about at Vanguard. I think most of the major mutual fund companies have them. You can put your money in a Fidelity Freedom Fund based on your age, and they will automatically allocate that money to a number of different Fidelity funds, some stocks, some bonds, international, domestic. And then as you get older and get closer to retirement, they will adjust your allocation to move more and more of the money from stocks to bonds. So the idea is you invest in one fund and then you don't have to worry about rebalancing and all that sort of thing. They sort of do it for you. And I think it can be a great alternative. It's not necessarily the right alternative for everyone, but certainly I think is an alternative to consider. But they've decided, obviously, from the email, they want to move it out of that fund into a selection of other funds. One of the reasons is, she says, that they found other funds there that have better expense ratios, lower expenses, and obviously that is critical. We've talked about expenses and how important they are many times, and I applaud Pam for being focused on the costs of these mutual funds, because it really has a huge impact on your overall returns over a number of years. And if you want to know more about investing costs, I encourage you to check out podcast 28, DoughRoller.net/podcast28, and that will give you my views on the costs of investing, how to keep your costs lower, and also just how to assess what those costs are. And that should be, that's a very important topic. I would add to that, you probably ought to also listen to podcast 63, DoughRoller.net podcast /podcast 63. That's the 4 hidden mutual fund fees. Podcast 28 focuses on, I guess, what I would call the main fee of a fund, which is the expense ratio. But funds charge other expenses or have other sort of drags on their return that aren't reflected in an expense ratio. And I cover that in podcast 63. So those are really the two, podcast 28, podcast 63. Okay, so let's talk about Pam's question and dollar cost averaging. I've really got sort of 5 things I want to go through. The first one is simply, what is it? What is dollar cost averaging? And it's a very simple concept. It's simply investing a set amount of money on a periodic basis. So, for example, if you were to invest, say, $100 a month, each and every month, you would be dollar cost averaging. That's the concept. Now, a few things that we need to focus on. One is, with dollar cost averaging, it doesn't matter what the market is doing. You're not basing your investing decision on whether the stock market is up, it's down. It's simply a set amount of money periodically, whether it's every week, every month, every quarter, every year, whatever. It doesn't matter what the market is doing, what the S&P 500 has done. It's the same investment, again, every month or what have you. Now, that has a couple implications. One is if the market is down, then your set investment will buy more shares, right? Whether you're investing in an S&P 500 index fund or Apple stock, it doesn't matter. Whatever the investment is, if the price of the investment has gone down, then your set amount of money will buy more of that investment, more of the shares. And of course, the reverse is also true. If the market is up, then your fixed investment, your dollar cost averaging, will buy fewer shares. Now, I mentioned earlier that Pam's situation is somewhat unique, and here's why. When most folks think about dollar cost averaging, they're usually faced with a decision. Do I invest a lump sum of money, say $10,000? Do I invest it right now? Or do I leave it in cash and invest, say, $1,000 a month for the next 10 months? That's usually the kind of question I receive. In Pam's case, the money is already invested. It's already in a Fidelity Freedom Fund, which is, depending on her husband's age and which one of the freedom funds it's in, is already invested in stock funds and bond funds already. And so in her case, to take it out of the Fidelity Freedom Fund and then to simply reallocate it to a number of individual stock and bond funds, there wouldn't be much difference. I mean, there could be a slight difference if the asset allocation, particularly the division between stocks and bonds, changed. If the Fidelity Freedom Fund, let's just make numbers up, was 50% stocks and 50% bonds, and they wanted to take that money out and put it into individual funds and have an asset allocation of, 90% stocks and 10% bonds. Then there would be, obviously a big change to their asset allocation. That may or may not be the case. But it's not a situation where they have all of this money sitting in cash and they're deciding how they should move it from that to stocks and bonds. It's already in stocks and bonds. So in that sense, I think Pam's situation is different. And I can tell you that if I were making that decision for me, I can't, as I've said before, I'm not a certified financial planner. I'm not a registered investment advisor. I'm not going to tell you what you should do. Those are decisions you have to make. I'll give you my thoughts on it and some resources that you can refer to and all that sort of thing. But I'm not going to advise you as to what you should do. If I were in that situation and I had a Fidelity Freedom Fund and I wanted to move it to individual stocks, I would just do it all at one time. Again, it's not much different. I'm simply taking the money from one fund that's investing in stocks and bond mutual funds and moving them into whatever, 3 or 4 or 5 individual funds that basically do the same thing, but presumably at lower cost. So I would do it all at one time. But that's Pam's situation. Where I see this come up more often, as I said, is when folks have cash. And the question is, do we invest the cash all at once or over time? And that brings me to the second point for today on dollar cost averaging. And this is, may surprise some of you. Dollar cost averaging is irrelevant 99.9% of the time. I know it gets talked about a lot. You read about it a lot. If you're focused on this sort of thing, it is irrelevant 99% of the time. Why? Well, most of us, for example, will invest in a 401k. So every paycheck, some amount of money comes out of our paycheck and goes into the 401k. Maybe it's 5 or 10%. Maybe it's a dollar amount, $1,000, $500, whatever your situation is. So in theory, we are dollar cost averaging, right? It's a certain percent, same amount of money every month or twice a month, however often you get paid. But it's not by choice. It's not as if we could say, you know what, this month let's just shove $40,000 into the 401k. We don't have that option. We don't have that option for a couple of reasons. One is, of course, there are limits to 401k contributions, but even putting that issue aside, most of us, we're contributing what we can, and then, of course, we're using the rest of the money to live, right, to pay our mortgage or rent, food, and all that sort of thing. And so it's not as if we've got this lump sum of cash and we're just deciding, no, that's not the way we want to go. Let's invest $500 a month in the 401k instead. We're doing that because that's just how the system is set up. The money comes out of our paycheck and goes into our 401k every time we're paid. And that's just how the system works. We're not really making a decision to do it that way. And by the way, that can be true. You may invest $1,000 out of your paycheck into a taxable account at Vanguard, or at Betterment, or at a brokerage house, wherever. And again, what you're doing is simply investing the amount of money you can afford each month. So it's not really meaningful. Yes, technically that's dollar cost averaging, but it's not as if you're confronted with much of a choice in that regard. You're simply investing what you can each paycheck. Now, with that being said, there are times, I think for most of us, they're relatively few, but there are times when this really is a choice, lump sum investing versus dollar cost averaging. When do those circumstances arise? Well, just a handful that come to mind. One is you get a big bonus at work. You get a $5,000 or, $50,000 bonus, whatever your case may be. And you've got this cash and you want to invest it. And you do have a choice, lump sum or dollar cost averaging. Maybe you get an inheritance from a loved one, or you get life insurance benefits. Someone passes away, and this can be significant. Maybe a spouse has passed away, and all of a sudden you've got $1 million. In many cases, tax-free from life insurance. So, you really do have a big chunk of money, and this is a really big issue and one that you're focused on. You could be rolling over a 401k to an IRA. Now, for many folks, you might just say, well, wait a minute. Yeah, it was already in stocks and bonds in the 401k. So when I roll it over to the IRA, even if it's at a different financial institution, I'll just invest it similarly. And that's perfectly fine. But you are confronted with that choice because you could just stick it in a money market fund and invest it slowly back into your asset allocation. So a 401k to IRA rollover could present you with this issue. Maybe you're just starting out and you're scared of investing, and that's understandable. And you've saved up a lot of cash, more than you need for an emergency fund, whether it's a savings account, a CD, whatever. And so you're going to move some of that into investing. And again, you're just not quite sure. You've got this issue, these dollar cost averaging versus lump sum investing. And I guess the last situation where this might come up, and it could come up in others, but these are just some examples, would be investing in an IRA. That doesn't come out of your paycheck. You could set up, by the way, a direct deposit from a paycheck into an IRA. But it doesn't come out of your paycheck like a 401k contribution does. And a lot of people just wait to the end of the year, even into the early next year before they file their taxes, and they put $5,500, which is the current limit if you're under 50, into an IRA. And I guess that's an option because you could, instead of doing that, divide it by 12 or whatever and just make monthly contributions into your IRA. So those are examples of when this issue of dollar cost averaging really does come into play. And so these are situations that you might confront, and you have to answer this question. And so that brings me to the third of 5 points today, and that is, all right, is DCA, is it a smart way to go? And is this something you should do or shouldn't you do? And this is really, we're going to cover this in the final three of the 5 points today. So point 3 is this. Really, the difference between lump sum investing versus dollar cost averaging, when you truly do have a choice, you've got this lump sum of cash and you're deciding how to invest it, comes down completely to market timing. If we think about it, take last year of 2013, if you were the first trading day of January and you had whatever, $100,000. Knowing what we know now, would you have invested it right away? Say if you're going to invest in an S&P index fund, yeah, you would. I mean, the market was up over 32% last year. So why would you want to spread that out over 12 months, where most of the time each month you'd be paying more for the investment and therefore getting fewer shares of your S&P 500 index fund? No, you'd want to invest right in January, and that way you'd get the full benefit of an incredible year where the return was over 32%. On the other hand, pick a really bad year where you think 08, 09 time period where the market was down. Well, then you would want a dollar cost average. Why invest in January when you know the market's going to go down? Why not invest each month? Yes, the market's going down, but with each investment, you're buying more and more of the investment. You're getting it at a lower price. And if this really, I think, underscores the problem with this issue, and that is there's no way to know. There's no way to know if you're sitting on a lump sum of cash right now. There's no way to know whether investing it all right now in whatever asset allocation and plan you have, or spreading it out over whatever, let's say the next 12 months or 2 years or whatever, which one is going to end up better for you, because we don't know how the market's going to perform. In fact, taking my example of a bad market where it's going down and down and down, right? Well, if you knew it was going to do that, you wouldn't do a lump sum or dollar cost, right? At least not in January. You'd wait until the end of the year or the end of the bottom of the market and invest then, right? But of course, we don't know what the market's going to do. And so dollar cost averaging really is, when you've got that choice, lump sum versus dollar cost averaging, understand this. Neither one of them is inherently better. Which one will turn out to net you the most returns will depend entirely on the market, how the market performs, and the investments you choose over that period of time where you would either do a dollar cost average, or if you just started at the beginning and did a lump sum investment. Totally depends on the market, and I have no idea how the market's going to perform. I've stopped trying to predict it long ago. So that's point 3. It's really about market timing. Now, then the question becomes, okay, well, that's great, Rob. I get that. Market timing, but what should I do? I still have to make a choice, all right? Well, that gets me to points 4 and 5 today. Let's start with point 4. Our friends at Vanguard did a study, and I'm going to pull it up even while I'm recording this. I think it was in 2012. Yes, July of 2012. And this will be linked to in the show notes. Again, DoughRoller.net podcast 71. And they went back and they did a study, and they said, okay, well, let's compare. Let's compare dollar cost averaging to lump sum investing over a host of market conditions and see which one wins. And it was a pretty interesting study. They did a couple of things. The first thing they did was, because one question would be, well, okay, for the dollar cost averaging piece, how long will this dollar cost averaging last? And they actually did they calculated the results based on a number of different lengths of dollar cost averaging: 6 months, 12 months, of course, 18, 24, 30, and 36. So what they did was they compared lump sum investment of $1 million, I think was the amount they used, on day one, versus dividing that amount up and investing it in equal portions over either 6 months, 12 months, 18 months, 24 months, 30 months, or 36 months. Okay, and then letting both investments, the lump sum and the various dollar cost averagings, sit there for a total period of 10 years. And they said, okay, let's look at the outcomes. Which ones did better? And they had an asset allocation. I think it was 60% stocks, 40% bonds. And so the question was, which one did better over that 10-year period? Would you have been better off investing all of the $1 million in day one, or some dollar cost averaging over some period of time ranging from 6 to 36 months? Which one did better? I'll give you time to come up with your own answer to that question. The answer, according to the Vanguard study, is that lump sum investing performed better, beat dollar cost averaging 67% of the time. So 2 out of every 3 evaluations that they performed, dollar cost averaging underperformed lump sum investing. And that was true over a number of different market conditions. I mean, they went all the way back to 1926 and carried this all the way through to 2011. And a couple of interesting things. It didn't really matter which dollar cost averaging time period they picked, 6 months versus 36 months. Lump sum investing still outperformed dollar cost averaging most of the time. That's number one. Number two is, the longer the dollar cost averaging period lasted, the worse it did as compared to lump sum investing. So if you were going to do dollar cost averaging in this example, you'd have been better off doing it over a 6-month period than 36 months. So the longer you spread out the investments, the worse dollar cost averaging performed as compared to lump sum in investing. The other thing they found was that lump sum investing beat dollar cost averaging regardless of the asset allocation. I mentioned 60-40 split, but they looked at a number of different things. Lump sum investing beat dollar cost averaging even if the investments were put into 100% stocks or 100% bonds. Why is that? Well, over the long term, both stocks and bonds return more than cash. And that's just, it's been the historical record on investing. Stocks and bonds, over the long term, both do better than cash. So even if you were going to invest 100% in bonds, according to this study, lump sum investing would beat out dollar cost averaging about 2/3 of the time. And if you were going to invest 100% in stocks, same result. Now, so what do we take from this study? Well, if you want to play the odds, if you want to look at just the math, according to the Vanguard study, you would be better off most of the time with just putting all your money into whatever asset allocation you have, moving it into the stocks and bond funds that you've chosen all at one time, rather than dollar cost averaging. Now, I do think there are a couple of sort of asterisks, if you will, footnotes that we need to talk about. The first one is this. One of the things, as I read the study, that it doesn't discuss is how expensive or cheap the market is when you're making this decision. I would have liked, I don't think this is, I've read the study, so unless I've missed it, and I don't think I have, maybe I'll reach out to Vanguard to see if they have data on this. I would like to have looked at this from the perspective of what the PE ratio was of the market when the lump sum versus DCA periods began, and compare that. That would have been interesting to me. Right now, most view our market as expensive. Not perhaps as the most expensive it's ever been, but most kind of view the market as a bit overvalued. And so I wonder if in today's market, if we were to look at similar markets, based on whatever measure, I think price to earnings is maybe the easiest, but you could debate that, but whatever. And look at similar periods going back to 1926 and starting the analysis from those years when the PE was comparable then to what it is today. How would lump sum investing do compared to dollar cost averaging? I think my hunch is there would be significant differences from the results that the Vanguard study showed. But again, obviously don't have data on that. I've not done the back testing, nor would I have the ability to do it with the data at my disposal. So with that, you might be saying, well, then, Rob, if I'm listening to your podcast now and I've got this decision to make, are you saying that because the market is maybe a bit expensive, that dollar cost averaging might end up doing better than lump sum investing? I'm saying that if I were faced with that decision, it would be something that I would be thinking about. Which one will do better? There's no way to know. If you're confronted with that decision, you're going to make whatever decision. And we just don't know what the markets are going to do. Even a market that seems a little more expensive doesn't mean it's going to go down. Look at interest rates; they were ridiculously low at the beginning of the year, and the 10-year Treasury has actually gone down, which just is crazy. Mortgage rates have actually gone back down this year. You can't predict the market. If you want to follow the Vanguard study, it would suggest, putting aside the current market conditions, that you have a better chance of coming out ahead with lump sum investing than dollar cost averaging. Should you factor in the market? Again, I think it's something you probably ought to consider, but I've just not been good at timing the market. So in my case, if I were faced with the decision, I would likely just pick my asset allocation and get the money to work, put the money to work right away. That's usually my approach. But this brings me to the fifth and final consideration for today with dollar cost averaging, and that is the emotional side of it. I think so many personal finance decisions are, you want to look at the math, right? You want to look at the Vanguard study. I think it's a great study, something to consider. But you've also got to look at your own emotional makeup and how, if you move all your money into a 90% stock, 10% bond allocation right now, and the market over the next 6 months goes down 40%, how are you going to react to that? I think in the long term, you'll be fine if you just stick to it. Over the next 20 or 30 or 40 years, my opinion, it'll work out. But a lot of people are like, I made this huge mistake. I can't believe I did that. And you pull your money out, change your asset allocation, abandon your plan. And if that's you, or you think that's a real possibility, or you're really afraid of that outcome, and you think, well, I'd rather try to soften the impact of a really bad down market, and I'm willing to give up some of the returns if that doesn't happen, and maybe in 2014 or whenever you're making this decision, the market goes up again. I think that's something worth considering. We can't ignore how we're going to react emotionally, frankly, to either a good market or a bad market. And I think this is where investing requires you to really understand yourself. And if you're part of it, if you have a spouse or whatever, you have a family, you need to take their emotional makeup into consideration too. And so I think the Vanguard study is important. It's the math side. It's the Mr. Spock side of Star Trek for Star Trek fans out there. But you can't ignore Captain Kirk, right? He's the emotional guy, and we have a little bit of both in all of us. And so I think you need to take into consideration sort of the emotional issues and how you would handle a down market. Now, part of the way you can do that, by the way, is not in deciding between dollar cost averaging and lump sum investing, but rather your asset allocation. To me, that's really where you should be dealing and addressing with those emotional issues. Because if you're really scared of a big market downturn, then maybe 90% stocks and 10% bonds ain't right for you. And maybe you should be in a much more or less volatile allocation, whatever that might be, 60-40 stocks, 70-30, 50-50. We've talked about that at length. So that's the fifth and final thing, I think, in considering dollar cost averaging versus lump sum investing when you have that real issue confronting you. Look at the Vanguard studies, fine, but also consider your own emotional reactions to a bad market or a good market and how that might affect you in making your decision. And if you've listened to this whole podcast and you've said, Rob, that's great, I love it, appreciate all this, but you haven't told me what I should do, my answer to that is, or my response is, you're right, I haven't. I've given you some things to think about. I've given you a study to read if you check out the show notes. But at the end of the day, this is a decision you have to live with. And as a result, it's a decision you have to make. But I hope our coverage of dollar cost averaging today will prove helpful for you as you make that decision. And so if you have any questions about it, obviously, don't hesitate to reach out to me. and happy to point you in the direction of perhaps other studies or to give you any other resources that I can. And with that brings our show to a close. There we go. Hey, as always, you can get the show notes, DoughRoller.net/podcast71. Again, I'll have a link to the Vanguard study that you can check out. If you haven't subscribed yet, please do to the newsletter, DoughRoller.net/newsletter. It goes out every Saturday, packed full of personal finance and investing links to help you make the most of your money. Hey, if you haven't already, I would be grateful for a review of the podcast. You can just go to DoughRoller.net/iTunes. That will redirect you to the iTunes page where this podcast resides. You can leave a review and rating, and helps me make the show better. So I appreciate that if you have the time. And lastly, please send me any questions or topics you have. Love to get your email, dr@DoughRoller.net. As I've mentioned many, many times, I read every email and I respond to every email. If I've missed you, just let me know. That means it's gotten buried somewhere. Hey, until next time, remember, the best thing money can buy is financial freedom.